Good morning, guys. This is Greg at Achieving Your Goals at Breakneck Speed. Hey, I just want to give you a shout out here. I'm going to start to do a series on annuities and retirement planning. So today we're just going to give just a quick teaser and go over just a couple things. One, understand that there's different types of annuities. There's variable annuities, there's fixed annuities, there's immediate annuities. And then we have another one called fixed indexed annuities. We're going to talk a little bit about that as it pertains to retirement. The planning in retirement now today, annuities are getting a lot more traction than what they used to, even though they're the oldest vehicle out there in financial planning. So what is an equity indexed annuity? We're going to go over just how that works in the very beginning on how the growth is. So an equity indexed annuity is a vehicle that you can put money into, whether it's IRA money from your pension, from your 401k, or whether it's non-qualified money from the bank, from your CDs. Either way, that money becomes tax deferred. Now, if it's IRA, it's already grown tax deferred. But if it's non-qualified money from your bank or from a brokerage account, that is not tax deferred. So the equity indexed annuity will be tax deferred for both non-qualified and qualified funds. Secondly, how does it grow? Well, being that it's a fixed annuity with equity indexing options, there's a couple different things that are going on. There's the fixed portion of that part of the annuity, and that ranges anywhere from 1% to 2.5%. It just depends on what company you're with and what that bucket is at the time that you get that annuity. So that portion of the funds that you invest in the annuity will be fixed. Now, what's the next part? Well, within that, the equity indexed annuities, there's different areas, things like the S&P, the Barclays, the Dow, the Russell, the NASDAQ. There's different funds within the annuity where you can allocate, where we can spread out 100% of your money into different pockets. If you've got part of it into a fixed, that portion is a fixed interest. Outside of that, if it's in the equities part of it, it's not a fixed interest by any means. But we know that there's growth in the market, and the market does good. When we see the annuities growing anywhere from 5 to 8 to 9%. I had a client statement here that I had access to that I looked at that this last year had a 20% interest increase. Now, we don't see that all the time. So generally in the equity indexed annuities, to see 5 to 7 to 8% growth is a good thing. Now understand, that's not a guarantee. That's what the markets are doing. Now we have averages and historicals of what we know what's going on. But the difference is why is that annuity a good vehicle? Well, there's guarantees. There's different types of guarantees. Today we're going to just talk about the protection of your principal. And when you invest into an equity indexed annuity or a fixed annuity, which is a life insurance contract, the insurance company guarantees that the money you invest will never go backwards by any fault of their own. And that at the end of every year, when your interest credits are applied, raising your principal amount, now that becomes your new principal amount, never to go backwards by any fault of the insurance company. Now, you can take distributions, you can take withdrawals, you can turn on a guaranteed income for life. Some annuities have loans to them generally. The different ways that folks access money from their annuities are penalty-free withdrawals that range from 5 to 10% annually. They're just general RMDs, or required minimum distribution, as folks reach 72.5. And then there's what we call a guaranteed income for life, a pension, an income that you cannot outlive. Sometimes that can go for both you and your spouse, depending on how your annuity is built. So in understanding that there are guarantees within the annuity, and that annuity planning is getting very strong and a lot of traction with every different type of income, whether you make $100,000 a year, $60,000 a year, whether you're making $1 million a year. We see that annuity planning work in all different types of income. Now, they work at many different ages. Now, what we're recently seeing now is about age 50, folks are looking to start to look at annuities now because their companies don't have guaranteed income for life opportunities. Some of them don't. So that's a little bit about what I wanted to talk about. We're going to do some education daily. We're going to jump on here. But it's important to me that you know how the annuities grow, what part of the growth is guaranteed, and what part of the growth is not guaranteed. So if you have questions, comment below, and we can talk about that. So as always, it's been great talking with you. And again, achieving your goals at breakneck speed is something we do, we've done, and will continue to do for you. Have a great day.